Anthony Grasso here, bringing you financial news you can use. This video, I'm going to do a stock analysis on Lowe's. Now, the Q3 reporting is about to come out tomorrow. Do I think they're going to beat estimates, and is it a company worth investing in right now? Well, I'm going to get into that. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing, hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So this video is brought to you by Webull. It's an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you get 2 free stocks by using my referral link in the description down below. So everybody should know what Lowe's is. I mean, it's the world's second largest home improvement retailer behind Home Depot. Now, it operates in the United States and internationally. Now, the company offers a line of products for construction, maintenance, repair, remodeling, and decorating. It provides home improvement products in various categories such as appliances, decor, paint, hardware, millwork, lawn and garden, lighting, lumber and building materials, flooring, kitchens and bath, rough plumbing and electrical, seasonal outdoor living, and tools. I've definitely shopped there a lot, along with Home Depot. Typically, it's like I go to Lowe's and Home Depot. I try to find something at Home Depot. I can't find it. I go to Lowe's, it's there. So I'm at both stores all the time. So they also offer installation services through independent contractors in various product categories, extended protection plans like Home Depot, and in warranty and out of warranty repair service. Now, the company sells its national brand name merchandise and private branded products to homeowners, renters, and professional customers like Craftsman Tools. As of January 29, 2021, it operated about 1,974 home improvement and hardware stores around. Now, the company also sells its products through websites composing of Lowes.com and LowesForPros.com and through mobile applications. Now let's go look at some of the news of the company right now. So the biggest news right now regarding Lowe's is whether or not Lowe's will beat the Q3 results coming out. Now, analysts surveyed by FactSet are forecasting adjusted earnings of only $2.35 a share for Lowe's. In fact, last third quarter year ago, Lowe's posted earnings of 91 cents a share, or $1.98 on an adjusted basis. Now, analysts are expecting Lowe's to post third quarter sales slightly over $22 billion. That's compared with $22.31 billion 12 months ago. They are forecasting that same-store sales will decline about 1.3% year over year. So what do we need to watch out in this report that's coming out? Number one is the supply factors such as hard time finding workers, supply chain snags, and rising input cost. And two, we need to look at home improvement trends. Now, we saw home improvement sales shoot up earlier in the pandemic. Now, analysts argue that was a limited term pull forward in demand because of the government stimulus checks that gave a one-shot time boost for their home improvement spending. But I argue that home improvement demand is here to stay, and I will definitely get into that. So let's go ahead and look at some of the fundamentals of the company right now. So the stock recently closed at $244.78 a share today, and it jumped up about 4%. And I think it's mainly to do because of its Home Depot's Q3 beating estimates on its earnings report. And its market capitalization of Lowe's is about $169.5 billion right now. Now, the revenues are expected to be roughly $93.75 billion by the end of this year, with positive earnings of $7.98 billion. Now, the analysts forecast stagnant revenues slightly increasing over the next year, and by the end of 2024 to be approximately $98 billion in revenue, with a positive $8.48 billion in earnings. Now, Lowe's earnings are forecast to grow, but not significantly. And it's forecast to grow about 5% per year. Now, earnings have grown 18.5% per year over the past 5 years. Now, in my professional opinion, I think these analysts are being a little too conservative, and I forecast Lowe's earning to grow about 8 to 10% per year. So let's go ahead and look at some of the analysis here. Let's first look at the valuation analysis. Now, because the Lowe's is in the specialty retail industry and has positive earnings, the price to earnings growth ratio, PEG, and the price to earnings ratio, PE, are the most appropriate measures. Now, the price to sales ratio is less instructive than the PEG or PE since the company has positive earnings. Therefore, Lowe's seems fairly valued with a PEG of 1.37 times. That is in line with especially retail industry median of 1.07 times. Now, although their PE ratio is 24.22 times, above the industry median of 12.49 times, but that PE ratio of 24 is still below the S&P ratio of 28.29. Now let's look at the profitability analysis. Now, Lowe's is typically profitability characteristics of a company in the specialty retail industry. Now, while it is better than most at converting revenues to profits on a net and operating margin basis, its gross margins is on par with the industry. Now, the current net profit margins of 7.4% are higher than last year's, which were 7.1%. Now, Lowe's does have negative shareholder equity right now, which is kind of a more serious situation than short-term assets not covering short-term and long-term liabilities. But Lowe's debt is well covered, though, by operating cash flow of 26.1%. Now, Lowe's interest payments on its debt are well covered by EBIT, earnings before interest and taxes, of 14.6 times coverage. Now, its annual dividend yield is about 1.36%. Now, Lowe's dividends have been stable over the past 10 years, and they've actually been increasing over those past 10 years as well. And the forecast for over the next 3 years is they're well going to be covered by earnings, about 20% out payout ratio. So I'm going to bring it back here. So what did the analysts say on this one? Now, the consensus is a strong buy with a 12-month price target of only $241.82 a share, with a high being $265 a share and a low of $217 a share. It's definitely trading above their median of $241 a share right now. Now, going over a couple of the analyst reports, the New Constructs Fundamental Analysis Report does not recommend Lowe's. They have a neutral rating on it, which means that they believe that the upside potential is about equal to its downside risk. Now, the Street Quant ratings rates Lowe's as a hold as well. Now, the primary factors they have impacted their rating are mixed. Some are indicating strength, some are showing weaknesses, with little evidence to justify the expectation of either a positive or negative performance for this stock relative to most other stocks that they cover. Now, the company's strengths can be seen in multiple of areas, such as its revenue growth, solid stock price performance, and growth in earnings per share. Now, however, as a counter to those strengths, they also found that weaknesses, including poor profit margins and weak operating cash flow. The Ford Equity Research Team also has a hold recommendation on Lowe's. Now, their recommendation on Lowe's is based on their systematic analysis of the three basic characteristics that they look at. They look at earnings strength, relative valuation, and recent stock price movements. Now, they said the company has managed to produce a neutral trend in earnings per share over the past 5 quarters, and while recent estimates for the company have been raised by analysts, and they have been, Lowe's has posted a better than expected results. But based on operating earnings yield, the company is undervalued when compared to all the other companies they cover, and share price changes over the past year indicates that Lowe's will perform poorly over the near term. So on my buy, hold, or sell recommendation on Lowe's right now, here are my thoughts. I do see favorable consumer and housing trends that drive home remodeling and home improvement right now. Lowe's has been a big winner during the coronavirus pandemic. That's been thanks to rising home prices, low interest rates, and people spending more time than ever before inside. Completing those renovation projects they always wanted to do was the big focus for all the consumers over the past year. Now, let's examine what Executive Vice President of Stores Joe McFarland said previously in a Q2 report. He boldly claimed that Lowe's is the new home for pros. Coming from a company that has traditionally concentrated its efforts on the do-it-yourselfer, this comment is noteworthy, I would say. Now, during that fiscal quarter, though, Lowe's generated about 25% of its overall revenue from professionals. That consisted of customers like contractors, electricians, and plumbers. Now, Home Depot, on the other hand, during that same quarter, they got around 45% of its sales from pros. So it looks like Home Depot right now is the home for pros, and that Lowe's. And Lowe's has a large gap to fill in the meantime to catch up with Home Depot in that aspect. But Lowe's has been grabbing what I call the low-hanging fruit. Lowe's has been designing store layouts based on product adjacencies that helps pros get everything they need for a specific job without having to run around the entire store to find everything. Now, additionally, the website Lowe's for Pros was moved to the cloud, And McFarland said this allows for enhanced features, faster updates, improved site stability, and more personalized offers for the pro. Now, boosting the pro loyalty program, continuously adding members-only benefits like tool rentals and business management services should make it more attractive as well to the pros. Now, Lowe's is executing better right now, in my view, especially on the customer service and store management aspects. Now, while year-over-year sales comps were challenging, the do-it-yourself segment showed about a 10% sales increase in quarter one of fiscal year 2022 versus the same period in 2019. And the pro segment contractors gained about 21% on the momentum with home remodeling projects as more customers invest in their homes. Now let's look at the competitive landscape because, that's what we have to look at. Now, Lowe's is second only to the market leader, Home Depot, as we know. While it's never good to be in the behind, now Lowe's has an upside potential to regain market share with better execution of its business plan to improve customer service, store availability of the most widely sold 1,000 items, and efficiencies in purchasing, supply chain, and store management, in my view. Now, Lowe's has a home center exclusive on Craftsman products, meaning you can't get them at Home Depot or any other stores. Now, Lowe's management acknowledges that the company has a disadvantage to Home Depot. Now, in the real estate locations in metro areas in the Northeast and West Coast markets, besides the physical store locations, Lowe's will work hard on targeting a do-it-yourselfer customer and its pro segment. From my perspective, Lowe's operational outlook is tied more to better execution than the competitive dynamics it faces with Home Depot in select U.S. regions. Now, Lowe's does have a potential to be greater omni-channel retailer, whereas it's able to connect and align its systems and processes to drive an improved customer experience via online and in-store shopping. In my view, home improvement segment has been the resilient to substitution by online providers such as Amazon, by the way, as professional and consumer customers like myself prefer to shop and pick out items in the stores. Now, Lowe's states that 6% of its e-commerce purchases are picked up at local stores. And then after I do that, I typically order something from Lowe's that I don't want to go find. I order it, it tells me it's ready, I go pick that up, and I go shop for a few other things. So I can see where that's the case. Now, Lowe's has a big labor presence right now and continues to grow employees base without any major labor shortages. Now, its pro segment has the opportunity and is still under penetrated versus Home Depot's right now. Now, I believe that management keeps executing on its strategy to attract the pros. Investors will take notice of this and the stock price will follow. Now, investors are looking for growth in their portfolio may want to consider the prospects of Lowe's before buying in, right? Although high value investors would argue that it's the intrinsic value relative to the price that matters the most, a more compelling investment thesis would be high growth potential at a cheap price. Now, Lowe's company's earnings over the next few years are expected to increase about 26%, indicating a highly optimistic future ahead. Now, this should lead to more robust cash flows, feeding into higher share prices and share value. So based on all of that, I am a buy recommendation on Lowe's right now with a 12-month price target of $260 a share. My fair market price right now, I put at about $249 a share. Now, if Lowe's beats the quarterly report that I'm expecting to see a boost in the stock price, that might have, happened already because of Home Depot's reporting as well, because we did see a 4% increase today. Now, analysts do expect them to not to beat the estimates, and if that's the case, I will probably see a 4% dip in the share price, and that's exactly where I would buy into Lowe's. If you think they're not going to beat the estimates, it's probably going to come down about 4%. I would then hold it for the long term. I personally think they will beat the street's estimates right now, but let's see if I'm right. Only time will tell. It's only tomorrow. But note that it's not always the earnings beat or miss that affects the price of a stock, but more of its guidance or forecasted performance. Now, I believe in Lowe's should be the core holding to invest in any consumer spending for the home. Now, Lowe's is a direct beneficiary of home remodeling done by the pro segment or the skilled the DIYer. Now, U.S. households embrace a spending shift to live, work, and play in their homes and benefit from significant wealth effect from higher home equity values right now. The savings rates are at an all-time high to total discretionary income, boding well for home remodeling, home appliances, and other categories. Besides these secular tailwinds, management is executing as well. Now, risk to my bullish outlook is the recession, possible recession, reduced customer confidence, and decline in home improvement projects if the housing market pops and cools off. then there'd be a lower spending on home improvement. Now, if home prices tank or consumers stop spending, home improvement projects would get pushed to the homeowners' back burners, and then sales they generate for Lowe's would probably dwindle, and many other bets in the stock market might suffer as well if that were the case. But I don't see that happening anytime soon. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.